That's like,
dude, bro. That's pretty.
I know. I love that. Actually, I might relate.
I'd actually be
Hello everyone. Last week together. Anyone graduating? Graduating. Alright. No slacking off in the last week. Right? Buckle down. Short time. Okay, the finals a week from today. At 1 o'clock in Bauer Hall 230. Right? Everybody got that? 2 sheets of paper, front and back, 4 total pages, handwritten notes. One handwritten because something goes from your brain to your hand. If you write something down you do not understand, spend more time with it. Right? It's not an idea of trying to write everything down and then match the question to the note paper. That's not going to do you well in the exam. Focus on the stuff we've talked about, and we'll go all the way up through what we talked about on Wednesday. That's going to be short-term memory, so you'll be able to talk about.
Can you repeat the room number?
Bauer Hall 230.
230.
Okay. No electronics again. Nice. It is, I just finished it yesterday, 16 multiple choice, 8 short answers. So the length is not much different than what we did on the midterm. You know, the university had blocked out 3 hours for us, so I'm not going to you for 3 hours in questions. Right? It will be comprehensive, equally weighted, everything that's talked about, you can prepare any content. I will give you the same depreciation stuff again as I did before, but nothing else. Because we haven't really done any more tables and stuff like that. Yes, sir.
Yeah, I had a question. So, is it going to be like a roughly like 50-50 split between the first half and the second half?
I would say yes. Yeah, I didn't favor the second half at all. And I view that as some of the stuff. I can craft a question that kind of builds on stuff for the first half of the semester. Okay. All right. Shoot me an email if you got any questions as you're studying on anything. Okay, Beta Alpha Psi has a presentation on Wednesday. This person, Olga, is a WashU alum, BSBA and MAP, and is now working in Amex, American Express, and she's doing M&A stuff. Okay, I think she's an M&A controller on the accounting side of this. We're going to be talking about how different areas from accounting and finance function together on the M&A throughout the deal life cycle. So she's probably going to be talking about this from the internal perspective, right? Companies mobilize internally, obviously, when there's an M&A transaction, but there's usually a set of advisors on the outside as well. So I imagine she'll be talking about the interaction and how Amex approaches the use of external versus internal resources. You guys go, ask her a question about tax. When do they get the tax people involved? And when they go to implementation, do tax people take the lead on that? And do tax people kind of take the lead on that, which is my experience. But each company is different, so it would be interesting to hear her perspective as to how they approach these transactions as well. So it might be well worth their time. Okay, so we are going to finish up partnership distributions in chapter 10. I think we're on around slide 18. Okay, so we're going to talk about operating distribution. So an operating distribution, we're talking about these are coming from the partnership, right? So ultimately, we want a partnership to make money, have cash, and make distributions to partners. A partnership distribution is an operating distribution if the recipient partner retains their partnership interest after the distribution. Okay, so you're an ongoing partner, you're not leaving the partnership. Partnership is not winding up business. We're just making a periodic distribution of the earnings and cash. And this is going to be our focus of our discussion here, operating distribution. The implications for the recipient partner differ depending on whether the operating distribution is cash or non-cash. We're going to go through each one of those. Now, note a partnership may also make a liquidating distribution. A liquidating distribution is when a partner fully withdraws from the partnership, so they will not be a partner after the liquidating distribution. Or it may also happen when the partnership winds up and terminates its operation, sending out whatever's left to the partners and again ceasing operations. The rules for liquidating distributions, I would love to take you through those. We don't have enough time. They are some of the more complicated stuff that I've ever encountered in the Internal Revenue Code. The basis rules that they do are extremely complicated, so we ran out of time. Okay, so we're not going to talk about liquidating distributions. You're not responsible for liquidating distributions. We're going to talk about operating distributions. So let's first start with distributions of cash. As a general matter, a partner does not recognize gain or loss from receiving cash from a partnership to the extent of its outside basis in the partnership. Okay. Contrast that with a corporation. When a corporation distributes cash, right, we know it's a dividend to the extent of E&P, then the basis, then cap gain. Right? You guys are going to know your distributions from corporations. Right? Distributions of partnerships are different. They're not taxable. But the governing aspect is it's not taxable only to the extent of my outside basis. What I do is I do reduce my outside basis by the amount of cash received. You know, it's not taxable, but I do a dollar for dollar reduction to my outside basis. I do recognize gain to the extent they receive a distribution of cash exceeding my outside basis. So if I do take a dollar more out than my outside basis goes to zero and I have a dollar of capital gain. The reason for that is that gain cannot be deferred to a basis adjustment to distributed cash. Okay? As a general matter, a U.S. taxpayer has full basis in U.S. dollars. So when we say cash, the premise is we're dealing with U.S. dollars. We're not dealing with a partnership distributing euros, right? Because again, euros might be cash, but they're property in the eyes of the U.S. tax code. Okay? So we're talking about U.S. dollars when we talk about cash here. So I cannot have gain or loss in U.S. dollars. Right? When I go to the store and I pay $20, that's not a taxable event relative to the $20. Because its worth is 20 and my basis is always 20. So when I have a distribution of cash in excess of my outside basis, there's no place to reduce basis. I can't embed a built-in gain in U.S. dollars. That's the reason I have gain. Importantly, the partnership itself never recognizes gain or loss on the distribution of cash to a partner. Okay? Nothing happens at the partnership level on the distribution. But this is the reason why I have to maintain those complicated outside bases and that dynamic outside basis goes up and down all the time as things happen. Because if cash is coming out periodically through the year, then I need to know what my outside basis is so I know how much cash I can receive without having a capital gain. So let's do our Examples 1010 is, okay.
Suppose CCS makes its first distribution to the owners on December 31st, 2026. Nicole and Greg received $250,000 each, and Sarah received $303,333.
So, very nice distribution, by the way. Nice to be on the other end of that. Okay.
After taking into account the distributed shares of CCS income for the year, the owners have the following pre-distribution basis in their CCS interest. Nicole has $205,000, Sarah has $420,000, and Greg has $334,000.
So I think if you go back to the slides, when you go back. It's at the end of chapter 9. At the end of chapter 9, when we were talking about maintaining outside basis, and I had a table and I had green for increases and red font for decreases. There's an example after that, and what that does is it takes that number puts to these bases that the partners had, because we did it in 3 columns. We had initial basis, and we had all the greens and all the reds, and then that's where we end up. This is picking up before the distribution of the cash.
So yeah, what are the tax consequences, gain or loss in basis and CCS interest of the distribution to Sarah? Sarah does not recognize any gain or loss on the distribution. Instead, she reduces her outside basis in her interest from $420,000 to $86,667, which is found from taking $333,333 from $420,000.
Yeah, so Sarah gets a large amount of cash, but she has a large outside basis. She can get cash out up to the extent of that large outside basis, as long as she doesn't exceed that. No tax effect to her, but for just reducing the outside basis down accordingly dollar for dollar. Okay, perfect. 1011, who's got 1011? All right.
So in this example, suppose that in this grade 1, Nicole's distribution consists of $250,000 cash, and her outside basis of her CCS interest is $205,000 before the distribution. And what is Nicole's gain or loss? The basis in the CCS interest after the distribution. And then Nicole has a $45,000 capital gain and a 0 basis in CCS. Because she receives only money in the distribution, she reduces her outside basis to 0 and must recognize the $45,000 capital gain, which is the difference between the $250,000 distribution and the $205,000 basis, and recognizes gain because she receives a cash distribution in excess of her outside basis and her CCS.
So in the above calc, we ended up with, they call it 205 outside basis. She got a larger distribution than that. So she takes that down to 0. And anything in excess of that, I can't embed the gain in the cash by reducing my basis in US dollars. So therefore, there's no place for it to go. So that excess distribution has to be recognized as gain in order for me to have full basis in the cash. And again, I caution you, they say money here and they say cash. What we're talking about is US dollars. If for some reason that's non-US dollars, then we could adjust the basis in that. That's the problem. You'll see that when we go here when we do non-cash. So the takeaway from example 1010 is Sarah had sufficient outside basis to cover the cash distribution. Nicole does not, right? Causing capital gain. Okay, so now let's shift to non-cash property, so non-US dollar property. So partner receiving property other than cash in the distribution takes a carryover tax basis in the property, which is the partnership's inside basis in the asset. Remember, outside basis is the partner to the partnership interest. Inside basis is the partnership's basis and its assets. Right? And so when I get a distribution of non-cash property, I take the carryover basis. The asset comes to the partner, the basis carries over to the partner from the partnership. However, the partners must reallocate some or all of their outside basis to establish their carryover basis in the non-cash property received. So ordering rules first allocate outside basis first to any cash received and second to any non-cash property received. Why do we do it that way? because I can't embed the gain in the cash property that I received. Right, we just went through that example. If I get cash, I have to have fair market value basis in the cash. So at first, if I get a distribution of cash and property, first I take it down for the cash, my outside basis. Then I start applying, I want to take carryover basis, so then I apply outside basis. I reduce that so that I can then take a carryover basis in that asset. If the partnership distributes non-cash property with an inside basis that exceeds any remaining outside basis after accounting for cash, the partner simply assigns its remaining outside basis to the distributed non-cash property and reduces outside basis to 0. I don't have a gain recognition. This allows for deferral of gain recognition upon the distribution. What I've effectively done, I embed that what would otherwise be gain, I put that in the non-cash property that I received. I can't do that in cash, but I can do it with other property, meaning that it's not currently recognized. If the partner does something with the non-cash property in the future, they'll have a greater gain. Again, the partnership itself never recognizes gain or loss in the distribution of non-cash property to a partner. Think back when we did corporate distribution. Corporations that distribute appreciated property recognize gain. Why? They're separate taxpayers, right? So I treat it as if they sold it, then I recognize that gain at the corporate level, and then I have a distribution of the value of that property to the shareholder. Partnerships do not recognize gain or loss on appreciated property. I just have a carryover basis mechanically. I do have to reduce the outside basis. So you kind of see this kind of aggregate approach that kind of filters through with partners and partnerships because I have to account for the non-separateness of the taxpayer. Okay. Let's do 12 is Allison.
Proposed CCS is December 31st, 2026 distribution of shares consists of 133,333 cash and investments other than marketable securities with a fair market value of 200,000 and an invested basis of 150,000. Sarah has a pre-distribution outside basis and her CCS interest of 420,000. Further tax consequences, Sarah's gain or loss basis of distributed assets, outside basis of CCS interest, and CCS's gain or loss of the distribution.
So let me pause you there. So if I go back to this example, that's the 420. So now we're dealing with the third partner here, Sarah. She's got a high outside basis of 420, but we're distributing cash and investments, so non-cash property.
So Sarah recognizes no gain or loss from the distribution. To determine her basis and the distributed assets, she first allocated 133,333 to cash and then carried on her basis to the investment. So her basis in the investment is 150,000.
Let me pause you there. So the only instance where the partner recognizes gain is if they get cash in excess of outside basis. She got cash of 133,333, but has outside basis of 420. Not going to recognize gain. That comes out first. Okay.
Sarah reduces her outside basis in CCS by 248,300, which is the 133,333 cash plus the 150,000 basis of investments. Her outside basis in CCS after the distribution is 171,667, which is the 420,000 minus the 248,333. And CCS does not recognize anything.
So all she does is simply reassign her outside basis to the cash, dollar for dollar. Cash is not in excess of that, so no gain. And then in order for her to get outside basis in the property, or sorry, to get carryover basis in the assets that were distributed, she takes carryover basis, but she has to reduce the outside basis dollar for dollar for the carryover basis. Okay. Now, I put up here the partnership had investments in the investments were worth 200,000 and the adjusted basis was 115, so there was an $85,000 built-in gain in the asset. She has that built-in gain as the partner, right? So she got something worth 200,000, takes carryover basis 85,000. The hallmark of deferral transactions is that her preservation of gain by how we assign basis. Okay, 1013 is, Megan.
Suppose Nicole's December 31st, 2026 distribution consists of 150K of cash and investments other than marketable securities with a fair market value of 100K and an adjusted basis of 90K to CCS. Nicole's outside basis in her CCS interest is 205K before the distribution. What are Nicole's tax consequences of the distribution? So Nicole is not going to recognize any gain or loss, and she's going to take a basis of 55K in the investments and then reduce her outside basis in CCS to $0. And to arrive at that latter amount of what her outside basis in CCS is, we have to first calculate her remaining basis after the 150K cash distribution. So that leaves her with 55K of remaining basis to allocate to the investments. But since CCS's inside basis of the investments of 90K exceeds her remaining basis that she has in CCS, she can't take a full carryover basis in the investments, and instead she's going to allocate that remaining outside basis of 55K to the investments and reduce her outside basis in CCS to $0. So this allows her to defer recognition of a 45K gain, which is the difference between the fair market value of the distribution of 250K less the outside basis she has of 205K. So then she has a greater embedded gain than CCS did in the investment.
So we have a place to put that excess inside basis that from a carryover. I don't have any place to put it in cash, but I do in the investments. So I just artificially give her, not artificially, the rules assign her a lower basis in the investments, which preserves the deferred gain on the transaction so that she doesn't recognize it on this distribution. But if she goes to sell the investments, then she's going to have the higher gain. And that, like you're saying, that 45,000 is the difference between the fair market value she got in the distribution of 250,000 and her outside basis, which was 205. So she got more value than her outside basis, which we normally think that should be gain, but instead we embed that gain in the investments. And we can do that because we don't want to recognize gain. Okay? So this is kind of the stuff that happens in partnerships. It's like the rules work really hard not to have gain and assigning basis. And when I mentioned the liquidating distribution, that's why the rules get all crazy, is because they're always trying to embed this gain somewhere in the asset. Okay. Last topic on distributions, the impact of changes in partnership liabilities. Remember the other, one of the other key differences between partnerships and corporations is the liabilities at the entity level impact the partner's basis in the partnership interest, the outside basis. It has no effect in the corporate world, right? A corporation's liabilities have no impact on your basis in the corporate salary. Okay? So, changes in the partner's share of partnership liabilities impact that outside basis. So partnership liabilities either go up, go down. They go up because you might borrow more. They might go down as they're repaying that. That's one of those dynamic features that affect the outside basis. So any changes relative to partnership liabilities must be considered before determining the effects of an allocation of outside basis to any distribution of cash or non-cash. So we have to first make sure we've covered off any changes in the liability share to the partner, and then adjust for what we just talked about, whether we have cash distribution or non-cash or cash and non-cash. And remember our partnership liabilities, when you go back and look at your notes, we have a difference between whether we're dealing with recourse liabilities or non-recourse liabilities. Recourse liabilities look at which partner is actually on the hook for this if the partnership liquidated and the creditor wasn't repaid. That's the partner who gets the basis. Non-recourse liabilities, meaning that the own partnership assets can be given to the creditor if they're not repaid, if there's a default, then that gets shared by partners based on their ratio of the ownership interest. Okay, let's do 1014.
Suppose Greg receives land held for investment with a fair market value of $250,000. Inside basis is $140,000 as his distribution from CCS on December 31st, 2025. He agrees to assume $120,000 mortgage on the land after distribution. His outside basis and his CCS interest is $334,000 before considering the distribution. What are the tax consequences, gain, loss, basis of distributed assets, and outside basis, and his CCS interest of the distribution to Greg? The answer is Greg does not recognize any gain or loss on distribution. His basis in the land is $140,000. His post-distribution outside basis in CCS is $278,000 as determined as follows. So his Greg's per distribution outside basis is $334,000. Then you add his mortgage assumed by Greg, $120,000.
So just always there, when you're dealing with mortgages and the assumption, where does it start and where does it go? Who's assuming whose liability? So make sure you got the pluses and minuses right. So this is a partnership liability that Greg assumes in the distribution line. I'll take it over if I'm Greg, right? That's no different than if I put cash in of that amount and the partnership repaid the debt. I would have got basis for the amount of cash I put in. Instead of doing that, just give me the liability and I'll take it. That gives me basis in the partnership.
And then Greg's per distribution share of mortgage is $36,000. You get that by multiplying the mortgage assumed by Greg times 30% ownership. Then you calculate deemed cash contribution from net debt assumption by subtracting the mortgage assumed by Greg and the Greg's per distribution share of mortgage. And then
So let me pause you there. So, right, I get a plus 120 because I'm going to take on the full liability. I'm assuming that from the partnership. So my outside basis goes up by 120, but I was a partner in the partnership at the partnership liability, so I did have 30% of it allocated to me, which tells me this is non-recourse debt because it's shared by ownership percentages. So I no longer have that because there's no longer a partnership liability anymore, right? So the net effect of that is 84,000 increase in my net outside basis, right? I take on the full 120, but I was on the hook for my share of 30% of that, so I don't have that anymore, so that's got to go up against the
and then you add Greg's per distribution outside basis and the deemed cash contribution from net debt assumption to get number 5, which is Greg's outside basis and CCS after debt changes. And then Greg's basis in distributed land is the carrier basis from CCS, which is $140,000. And then calculating 5 minus 6, you get Greg's post-distribution outside basis and CCS, which is $278,000. Greg must first consider the effects of changes in debt before determining the effects of the distribution. The tax rules treat him as making a net contribution of $84,000 cash to the partnership. The difference between the mortgage he assumes and his distribution share of the debt, Greg then allocates $140,000 of his outside basis and his CCS interest to the land and reduces his outside basis and CCS accordingly.
So this is where you just got to be very methodical. It's easy to read that first paragraph and be just lost. Like, oh my God, there's a lot going on in this thing. But just start with your pre-distribution outside basis. If there are liabilities involved or not. If there's no liability assumption and liabilities haven't changed, 2, 3, and 4 are 0. Right? There's nothing there. Then, do I have cash? Cash comes out first. If I have, then I take carryover basis. I either get a full carryover basis by a greater outside basis than the carryover basis. If I don't, then I'm going to have a smaller carryover basis number because I'm going to embed that gain that is realized, but I don't recognize that I embed that in the property, the non-cash property.
So say the instance of the partner gets cash and non-cash property, but the cash is so much they have to recognize a gain.
Yes.
How does the basis for the non-cash property work?
So that would probably, I would think, that's a great question. So he's saying I exhaust all my outside basis because I have more cash comes out than that. So I'm already recognizing gain, then I get non-cash property out. I think I have zero outside basis to assign with that, so I think I get zero carryover basis, which means I got fair market value, right? I got full appreciation built into that non-cash property that I received. Be very careful what you do with that property next. Big whopping gains. But I think if you just kind of parse these out, it's very mechanical as you go through these. Okay, so we had sales of partnership interest, right? The trick there was the normal rules apply. Amount realized, less adjusted base. I just had coffee with a ex-colleague of mine, and he was talking about, they did a big sale, and he was like, telling his people, he's like, amount realized, less adjusted base. It is. Every transaction. Let your gain or loss realized. The trick of sales of partnership interest is it's capital. The partnership interest, your partnership interest is a capital asset. But if some of the value is derived by odd assets, remember those unrealized receivables or inventory items, then I have to recharacterize what would otherwise be capital as ordinary. Because we don't want to have a skewing of the character from partially ordinary, partially capital to all capital.
So say there's a partnership with only two partners, and one of the partners wanted to sell their partnership back to the partnership. Can they remain a partnership since it's only
No.
one of them?
No. So the only limiting factor in ownership of partnerships is I have to have two. So if I don't, then the partnership automatically dissolves under tax law. So then I have a liquidating distribution, and then you're in another. I'll send you a slide deck if you ever get that, because it's a whole nother. So no, what one would have to do then, what you could do in that situation is have the other partner form a corporation and then sell some of the partnership interest to that corporation, so then you technically still have two owners. So there's planning you can do to try to keep the partnership alive and not just get down to one owner. And then we talked about operating distributions. Okay, we're done with partnerships. Again, I will just caution you, partnerships are another animal. You just got to think of it differently than corporations. And I think it's good to kind of compare and contrast them as the topics that we covered, whether it's in a corporate setting or a partnership setting, there's different rules. And we just kind of touch the high level parts of partnerships because you can go down many rabbit holes. Okay, so we're going to spend the rest of our time together on S corporations, chapter 11. So we're going to go through various parts of S corporations. And so S corporations are going to be kind of on the fence between some corporate-like features and some partnership features. Right? It's a hybrid entity. We're going to talk about the election because S corporations are C corporations that have met certain criteria and have affirmatively elected to be taxed as an S corporation. Right? You don't have to. Then operating issues, basis issues, operating distributions, filing requirements, and then there's a really nice thing I want to get to on Wednesday that is a table that the authors have done where they take all the, because we have similar topics we've talked about, formation, operating distribution, basis, and then they have columns which are corporations, partnerships, and S corps, and then trying to just compare how they are treated, those topics are treated differently under those different types of businesses. Okay? So S corporation is a hybrid entity, meaning that it's going to be treated differently by different shareholders. So it has some tax characteristics as C corporations and others as partnerships. And remember, our C or S is just what section of the Internal Revenue Code, what subchapter of the Internal Revenue Code the rules reside. So subchapter C deals with C corporations, subchapter S deals with S corporations. Okay? S corporations are typically incorporated under applicable state corporate law. Everybody else is going to think it's a corporation. You're talking to the lawyers, it's a corporation. You're talking to Treasury, it's a corporation. You're talking to accounting, it's a corporation. This is a tax election only. So it's hybrid. We're all tax people. When tax people are talking about the entity, but just appreciate that when you're talking to other stakeholders, they're going to be like, I don't know what you're talking about with this S election. It's a corporation. Yeah. So it has the same legal protections afforded all corporations and so like legal liability protection. Remember, we started way back in chapter 1. One of the nice features of a corporation is limited liability of the shareholders, meaning your personal assets that are not involved in the business are not at stake, only your investment in the corporation. An S corporation has that because that's a state law limitation, right? The S corporation gets sued, all the assets of the S corporation are at stake, but not the personal assets of the S corporation shareholders, just like C corporation shareholders have to be different from a partnership. Okay? So normally you'll see a C corporation, so you form a corporation, right, under state law, it will default to C corporation treatment, meaning if you do nothing, it's a C corporation. So all the stuff we talked about a few weeks ago would be applicable. You can affirmatively elect to be an S corporation in certain instances. We're going to cover that in a moment. That's your normal path to S corporation treatment. You start off as a regular corporation, you just elect to be S corporation. Alternatively, an S corporation could first be legally formed, as a limited liability company under state law, and then have that LLC elect to be taxed as a corporation under the entity classification rules we talked about. Then once you're taxed as a corporation, you can then elect to be taxed as a subchapter S corporation if you meet the requirement. So that's kind of a separate way to do it. Now, I wouldn't know, I'm not sure there's a real reason why you would do one versus the other. But you also don't have to, it doesn't have to be a brand new entity. You can make an S election for a C corporation that's already been in existence. You can make an S election by taking an LLC, electing to be a Corp, and then electing to be an S. So you can have like a midstream S election as well. Complexity explodes on that front as well. We're not going to talk about that. We're going to assume our S corporation starts from day one, and we elect to be an S corporation from day one. Okay. An S corporation is subject to the same tax rules applicable to C corporations implicated in formation, reorganization, and liquidation. So remember that timeline that we went through for corporations? We formed it. That's the 351 stuff, 3 requirements. And we can do lots of things in the middle. We can buy assets, we can buy stock, we can do reorganization, all those types of things. And then liquidations. We can end up winding up the operation and liquidating the balance sheet of the owner. All of those C corporation rules apply in the S corporation rule. Okay? So you're not relearning those things. 351 in the S corporation, when you're trying to contribute assets to it, is equally applicable. Remember that was transfers of property in exchange for stock, and the control group owns 80% afterwards. C corporation, S corporation, those equally apply. Much more strenuous than partnerships. Partnerships didn't have that last party. You didn't have to have the ownership percentage. Get back to partnership interest. Okay. However, unlike a C corporation, an S corporation is a flow-through entity for tax purposes and shares many similarities with partnerships. For example, a flow-through of annual tax results, the maintenance of basis calculations, the complexity of distributions. So all that stuff we just went through in partnerships is present because the S corporation is a flow-through. It does not pay tax, right? It has a tax return, but then it distributes all of its results flow through to the owners, just like the mechanic of the partnership files a tax return, and all its results flow through to the owners. Okay. An election for an S corporation treatment is not limited, as I just mentioned, to newly formed corporations. It's possible for an S corporation to have previously been a C corporation, which adds added complexity. flip midstream, then you just got, you're just asking for some headaches that you have to deal with. Not insurmountable, because there's plenty of S corporations that were previously C corporations. That's extra stuff you gotta do. So, upon formation of an S corporation, same tax rules we just mentioned governing C corporations. Upon formation, apply contributions to S corporations. So 351 is our operative section. Applies when one or more persons transfer property to an S corporation in return for stock, and immediately afterward, the transfer group collectively owns at least 80%. Remember, the rationale is exactly the same: to allow the formation of corporations with appreciated property on a non-taxable basis, such that the tax implications do not interfere with business decisions, and where there is continued, albeit indirect, ownership of transferred assets. Right? So the whole rationale of why we allow people to form C corporations is equally applicable to why we want them to make a decision and potentially do an S corporation absent tax constraints.
So can a C corp be eligible to S corp if they have more than one class? Yes, for example.
No.
Or more than preferred.
No. There'd be restrictions. So it's not every C corporation can be an S corporation. That's one of the reasons why S corporations are much smaller in population than C corporations, is because there's just more constraints. A corporation, Jeremiah's question, a partnership needs 2 owners. A corporation can have 1 owner. It can have 1 million owners. Right? So it's the one that is least restrictive in terms of number of owners as a C corporation. We'll see in a moment, S corporations have a certain profile because they can't have a large number of shareholders. They can't have different classes of stock. And a partnership is very flexible, right? We know we can do all kinds of nice things in the partnership agreement, but I at least have to have 2 owners. So slightly more restrictive in that I can't do the 1 owner aspect that I can do when I can do a corporation.
Voting power
So the voting power, I think,
has to be the same.
I think I can have differences in voting powers. So I can't have differences in voting power, but I can have different classes of stock. Now, one might think of that as 2 different classes of stock, right? If I have 1 voting and 1 non-voting, I would normally think of that as 2 classes of stock. But you have to just get into the granularity of what exactly is required and what is not. What I can't have is a preferred return and a common return. So I can't have those. Those would definitely be 2 classes. I'd be stuck with corporate, or maybe can I do that business and partnership form? Okay. So my same rationale as to why I allow a non-taxable contribution to an S corp applies, same as a C corporation. Recall gain or loss is preserved via the tax basis the transfer shareholder takes in the stock received. Substituted basis, right? I substitute the basis in the assets I put in, becomes my basis in the stock I receive out. And the partnership takes a carryover basis, the basis follows the asset. Right? I take the asset, the basis that the person who transferred it to me, that basis carries over. Same, very simple on formation. The eligible corporations, which we've been kind of touching upon, to be eligible to make the election, the corporation can only be a U.S. corporation. So, those of you that are in my international courses, we have foreign entities. Foreign entities cannot make an S election. Only for U.S. corporations. They can only have 1 class of stock. The corporation is considered to have only 1 class of stock if all of the outstanding shares provide identical distribution and liquidation rights. That's where the preferred stock is going to catch you, because they're going to have preferences either on distributions or on liquidation. Feature preferred stock. Differences in voting powers is possible. You need to carefully consider debt instruments with equity features. Okay. I think in the first part of this course, we talked about interest deductions. And the first thing, if you remember that, we have to have it properly classified as debt. There's very creative people out there who make an instrument where they advance funds. Is it debt or is it equity? It has lots of different features in it. So we first have to make the call, is it debt or equity? That drives, because I get interest on debt, I don't get interest on equity. Right? I get dividends on equity. So that's important for that context. It's also important here, like, are you a shareholder or not? If you are a shareholder, think about something that's got debt-like characteristics to it. That's going to start looking like preferred stock. Because creditors are ahead of shareholders in terms of liquidating rights. And so you might run afoul of having multiple classes of stock if you've got a very creative debt instrument. Some of these things I'm going to point out to you are caveats for where people have thought they met the S requirements and then they have a foot fault and they, it hurts their ability to characterize the entity as an S corporation. And you must not be specifically identified as an ineligible corporation. I just point that out here, that's a relatively rare case. Okay. The one class of stock requirement can be somewhat challenging if providing for flexibility among different ownership groups is designed. Okay. So trying to compensate one shareholder group differently than another one, you're going to have a problem because that's going to be having more than one class of stock that you're getting preference. That's going to frustrate you.
Can you elect to be an S Corp in the bad years and the C
Say again, sorry.
In the bad years, can you elect to be an S Corp? And then when you're doing well in the good years, can you elect to be a C Corp?
Yeah, so in the bylaws, so the bylaws are kind of the governing instrument of a corporation. What I've typically seen those are pretty high level. Like, okay, this organization is going to do manufacturing and sale of widgets, you know. So it kind of gives the direction of that. But if I were advising you, I would say don't put whether you're going to make an S election or not in the bylaws. Just leave it out. I don't think you're going to have much pushback that somebody's going to complain about that. And why I say that is you'll see when we get to the S election mechanics, every shareholder of a corporation electing S corporation status has to sign the election. So by definition, if you saw the bylaws of a corporation and you said, oh, it doesn't say anything about S elections in there, you would still be protected because they can't make the election without you signing. And the reason it's an all shareholder requirement is because you're effectively changing a fundamental tax reporting of that entity from being separate to being flow through. And so we can't have 2/3 of the partners, 3/4 of the partners wanting flow through and the other one saying, whoa, I didn't want flow through. I wanted separate treatment here. So all shareholders have to sign. So I think there's a way to protect yourself without being too explicit.
Also, if that was possible, isn't it from?
Yes. So like I mentioned, you can do it midstream, but then you do have requirements that you can't. I think the way the rules work, I took this out because we just don't have that much time. I think you can revoke your S election, but then I don't think you can re-elect for 5 years. So the government doesn't want you toggling back and forth and just going crazy with it. But I think you elect, and then you can revoke because it's an affirmative election. So you can pull the election, which means you go back to C corporation treatment. But I think once you revoke, then you got a 5-year wait. So I believe you get like 2 decisions. First, your election, your affirmative election. Second, your revocation. Then you can't go a 3rd time. And I think that's just, you see those 5-year rules a lot because the government just like, hey, I gotta administer this. You can't be changing all the time. It's just too complicated. Okay, 11.2 is Yubo.
Suppose Nico were the resident of the Toronto, Canada, and will she form CCS in the Canada under the Canadian law, and she still plan to do the business in the United States? Is CCS eligible to elect as corporation status in the United States? So the answer is no. CCS would not be eligible for S corporation treatment. And because it was neither organized in the United States or formed under the US law.
So that just goes to the point, right? It's got to be a U.S. corporation, but how do we determine if you're a U.S. corporation? We determine that by place of organization. Where were you incorporated? What state? It doesn't matter where you do business under the U.S. view of residency for a corporation. So the facts tell you plans to do business in the United States. That doesn't make you a U.S. corporation. This was formed under Canadian law. Okay?
Both legal resident in Seattle and formed CCS under the state law of the Washington, but plan to do a significant amount of business in Canada. So would CCS be eligible to elect as corporation status? So the answer is yes, because the CCS was formed under the law of the U.S. state.
Yeah, so just the inverse of what I just mentioned. Don't be sidetracked by where it's doing business. That's not the test. It's place of organization. They formed it under the state laws of Washington. It's a U.S. corporation. Okay, so there are limitations. Yeah. Right.
Like the previous example. So let's say that I am a resident in the state and I form a corporation in St. Louis, but one of partners of the other shareholders are non-US citizens.
Yes.
From Germany.
Yes. So that's going to get you here because your shareholder limitations are going to come into play here. So that's going to frustrate that as well. And I think it's because the U.S. wants to make sure it can tax all of the income. Okay? So this started off as a C corporation organized under the U.S. tax laws. So as a starting matter, the U.S. is going to be able to tax all of it, right? Because a U.S. corporation has to file a tax return, it's taxed at 21% on its U.S. activities. If instead I allow it to be an S corporation, that means I'm giving that up. I'm not taxing it at the entity level. I want to make sure all the shareholders pick up 100% of that income and report it in the United States. If I allow a German shareholder of my S corporation, then that means that percentage ownership has went out of the United States. How do I tax that? I think that's why you have this first shareholder limitation, is that only U.S. citizens, residents, estates, certain trusts, and tax organizations may be U.S. shareholders. Just because they were giving up that 100% ability to tax those results in the U.S. I want to get all the shareholders to also report that in the U.S. So, unlike C corporations and partnerships, S corporations are limited to the type and number of owners and shareholders. Right? What Arthur just mentioned, if that's Apple, which is a C corporation, it doesn't care, and I'm sure it has shareholders from all over the world. Doesn't matter. Why? Because Apple's a U.S. taxpayer. It pays tax on all its results right there. Okay? A partnership. Partnerships have partners from all over the world as well. They can. Right? So again, very flexible in the ownership aspects of those two business entities. S corporations much more limited. And so the types of shareholders, only U.S. citizens, residents, estates. So we don't do estates and trust here, but think of U.S. citizens and residents, U.S. taxpayers. Right? Another S corporation, C corporation, or partnership cannot be a shareholder in an S corporation. So you see many instances where I've had one box on top of one box. I can have a corporation owning another corporation. You see these big organizations you're going to deal with. You're going to have a parent organization that's going to own 200 subsidiaries, right? It's corporations on top of corporations. That's possible. You see lots of times, Connor's not with us, but you see partnerships owning partnerships. That's in the investment context. And those types of investments are very complicated, but you can stack partnerships on top of partnership. Very difficult to stack anything but individuals on top of an S corporation.
Why do they have to be U.S. citizens if they're able to be like non-U.S. for partnerships and C corps? Why for S corps do they have to own that?
I think it's just from the function of we're trying to allow this flexibility to switch from double taxation of corporate profits, which are in the C corporation context, to a flow-through structure but we don't want to allow any of that income to escape the US taxing jurisdiction. So one way to do that is to make sure all the owners are US taxpayers and to prevent any leakage that might happen from that. But it's a good question. I mean, in theory, I think you could probably have designed or enacted this law to allow non-US taxpayers to be owners, but then you need them to report and pay tax on the results. And probably, I'm guessing, because these are very old laws, I imagine when Congress enacted these laws, they didn't want to go down that path and try to chase these people to file US tax returns. I just let it flow up to other US taxpayers and they'll have to report it under their normal operations. Okay, I highlighted number 2 here. S corporations cannot have more than 100 shareholders. Parenthetical, certain family members are aggregated and count as one. This is the major limitation of S corporations from a publicly traded standpoint. That's why publicly traded companies are not S corporations. Because their shareholding explodes and they cannot possibly keep it under 100. Okay. So where you mainly see S corporations are in the closely held founder situations where a small group of people form the business and they're going to be the owners of it. You see it in family businesses, again, closely held family businesses where there might be, multi-generational, but you can manage the 100 shareholder limitation and you can make sure that nobody's selling stock to 5 other people and those types of things. So you can put some controls in there to make sure that doesn't happen. But that's where you see S corporations. Now that does not mean that S corporations are small. As a general matter, they are relative to your big public companies, but there are some gigantic S corporations out there. Anybody heard of Koch Industries? Not C-O-K-E, but K-O-C-H, out of Wichita, Kansas. It's a huge conglomerate of industrial companies. It's the Koch brothers out of there, but that whole family owns that. Koch Industries is an S corporation. Anybody heard of Cargill? Cargill, big conglomerate, multinational, that's based out of Minneapolis. Again, family owned, very complicated org structure, but can meet these requirements. It's an S corporation. If those are publicly traded companies, they'd be some of the biggest companies in the world. Private. So don't think of S corporations as just mom and pops. There's some gigantic S corporations out there. Why are they attractive? One layer of tax. Not the double taxation of corporate profits. Koch brothers are very astute business people. You talk to them about, I'm going to pay tax at the corporate level and make distributions and it's taxable again. It doesn't take them too long to think like, my share of the pie is too small. Oh, there's this S election. I'll make that S election and have one layer of tax. So, but cannot be publicly traded S corporations are not there. So if any of those companies ever decided to go public, they'd have to go through the whole administrative aspect of revoking the S election and then get their ownership structure ready to go public. Fascinating transaction to be involved in as a professional. If Cargill or Koch Industries ever went public, I'm trying to do that transaction. Okay. 11.1 is Lucia.
Yeah, so suppose CCS was formed with Nicole Johnson, Sarah Walker, and Chance Inc. Corp owned by Chance Armstrong. Would CCS be eligible to elect S corporation status? No, because one of its corporations one of its shareholders are a corporation, so they wouldn't be able to elect S corp status. And then suppose Nicole, Sarah, and Chance recruited 97 U.S. residents to become shareholders of CCS. And then Nicole gave several of her shares to her grandfather and his spouse as a wedding gift, and then to her cousin as an MBA graduation gift. After the transfer, CCS had 103 shareholders, and now elects S corp status. And this time the answer is yes, because Nicole has a common ancestor with her cousin, and then her grandfather is his ancestor, and then her grandfather's spouse is the spouse of a common ancestor. So they're all treated as one shareholder.
So this example is just showing you the ongoing headaches of maintaining S status. Right, you gotta monitor your shareholders. You don't have to do that as a C corporation. You don't have to do that as a partnership. But here, if I run afoul of these requirements, like inadvertently Chaz Inc. buys some shares as a corporate, I can't have a corporate shareholder. The S election is no longer valid. If for some reason somebody sells their shares and this, forget the family attribution here, I sell it to 3 extra people and now I got 103 shareholders, I can't be an S corporation anymore. So that's an involuntary conversion is what it's called. And that terminates the S election, which makes it go back to a C corporation. So it's just, that's why it's just a little bit more cumbersome. Completely cannot be a public entity because you can't control 100% of the 100 shareholder limit. But you still have to maintain and ownership of this. So what you see a lot of times is within the bylaws, you'll see what you can and can't do from a shareholding perspective. That's how the Koch family makes sure that they don't run afoul of this because they don't want to lose their S election. So it'll be one of the shareholder limitations that'll be embedded within the governing documents. Oh, sorry, Jeremy.
You basically answered it. I was gonna ask, can the S Corp control who the shareholders sell their shares?
Yes. Yeah, so you can have shareholder level agreements that you have to sign that'll try to put some governance around this so that what you can and can't do. Now, the reason that works, because in a family setting, you can do that, right? You can tell your siblings and your children what they can and can't do. Here's an agreement, and we sign it, we agree to it. In a public setting, you can't do that, right? Like, again, I made the examples many times. You guys can get online right now and buy Apple stock. You don't have to have anybody's permission. There's no agreement that can't do that, that tells you can or cannot be a shareholder there, which makes them much more liquid, right? Because then you can sell, you can exit that investment as well. Corporations are much more closely held. Okay. So here, taxes in the real world. We have lots of entrepreneurs at our university. If you're planning to launch the next Uber, you might want to rethink making an S election. So many startup companies with plans for Uber growth, tax humor, seek outside investors through venture capital firms. Venture capital firms are generally organized as limited partnerships. These are investors that come through those investment vehicles. Many times they come through a limited partnership who is then making the investments in these startups. A limited partnership, if you go back on our slides, in the law, cannot be a shareholder in an S corporation. Okay? So if you're intending to finance your investment by investments from private equity and other investment houses, you're likely going to have partnerships involved, which is really going to frustrate your ability to be an S corporation. So think about what your options are. C corporation, partnership. Those things don't care about who your shareholders are. So again, think about that. You might be stepping into a C corporation, you have some downsides. You get double taxation. Profit law. Partnerships, you got to deal with all the partnership rules. So think about who your investors are and are they compatible with or not compatible with S corporations. I'll go back to my Coke Industries and my car. They don't need funding. Self-funding, cash flowing. So they don't have this problem of needing investors to come in. This is talking about more in the startup entrepreneurs. The election mechanics, an eligible corporation must affirmatively elect, right? You don't have to do anything. You default to a C corporation if you're organized under state law, corporate law. You have to affirmatively elect. It's your choice to be taxed as an S corporation. It's made via filing a form, 2553, election by a small business corporation. To begin S corporation status for the current year, the election must have been filed by either the prior tax year or the 15th day of the third month. So we're April 20th. You cannot be an S corporation for this year if you're calendar year because you're outside March 15th. So the earliest you can start is January 1 of 27. Okay. All shareholders on the date of the election must consent to the election, meaning they have to sign. Okay? That's again to prevent a majority imposing a drastically different tax result on a minority investor. Okay? 11.3 is Ava.
Suppose Nicole formed CCS as a C corporation in 2024 with a calendar tax year and finally got around to electing S corporation status on February 20th, 2025. What is the earliest effective date of the S corporation? Since she submitted the S corporation status before the third month, the answer would be the earliest effective date would be for the current year, January 1st, 2025.
So you can go backwards so long as you're at the first part of that year.
Suppose Nicole formed CCS as a C corporation in 2024 with calendar tax year and made the S election on March 20th, 2025. The effective S election would be in the following year, January 1st, 2026, because the election was made after March 15th, which is the 15th day of the third month.
Yep. So don't, moral of the story is don't be thinking about it too late in the year if you want it to be effective. Okay, thank you. Okay, this is the involuntary termination as mentioned before. So it can result from failure to continue to meet the corporate or shareholder level requirements. The latter is the most common inadvertent pitfall. So like the corporate level ones with the two classes of stock. So at that point in time, you're usually going to have a lawyer that's helping you with the classes of stock. And if you're trying to implement a second class of stock, hopefully somebody's going to ask the question, have you made an S election? Because below that S election, what is more likely to happen is the shareholder level requirements. If somebody sells to a corporation or your shareholder base expands beyond 100 shareholders. And that's a footfall, people call it blowing the S election. But that means you are no longer allowed to be an S corporation, you fall back to being a C corporation. It is, the termination is automatic and it's effective on the date the requirements are no longer met. So, good as long as you meet all the requirements. The moment you stop meeting the requirements is the moment you stop being an S election. If the IRS deems the termination inadvertent, it may allow the corporation to maintain S corporation status provided the requirements are satisfied within a reasonable time. So I've seen companies, they have an inadvertent foot fault, as people call it. But if I accidentally something happens, somebody sold their shares to 2 other people and it caused me to go to 101 shareholders and I find out about it 6 months later, I can go to the IRS and say, hey, I had an inadvertent involuntary termination of my S election. If I fix it, in the next month, will you agree that I didn't terminate my S election? That's at the discretion of the Internal Revenue Service, and it'll be fact dependent, right? Do you have any procedures in place where you try to track this stuff if you've done your best, but something happened, mistakes happen, right? So many times you can get the government to allow you to keep your S election if you fix the problem. Okay, 11.6 is Jessica.
CCS was formed for the calendar year as corporations with Johnson, Sarah Walker, and Chance are shown as equal shareholders. On June 15th, Chance sold his CCS shares to a solely owned C corporation, Chance Incorporated. Is CCS's S election still in effect at the beginning of 2026? If not, when was it terminated? Since S corporations may not have corporate shareholders, no, the election was automatically terminated on June 15, 2025, when Chance Incorporated became shares.
Yeah, so this is where you would try to protect that. And this could happen, right? Because it says that this individual sold it to their wholly owned corporation. No one may know that, right? It may not be a transaction that you find out about right away. It might be after the fact, and you're like, when you're doing the tax returns, and you say, oh, send those results not to Chance, but to Chance Inc. You're like, oh my God, did you say Inc.? We can't have a corporate shareholder. And that's where you might find out there was a foot fault, and then you go plead mercy from the IRS to say you didn't know about it and you fix it. try to unwind that transaction. Okay, thank you. Never mind.
Do S Corps have to report their shareholders to the IRS?
That's a great question. I do not know that. That's a great question. I'll look at that. If there's a reporting for that, or if it's just they put the requirement on you, and if they find out you blew it, then you blew it. What you don't want to find out is you don't want to find out about this like 5 years later. Then you're, if you guys practice long enough, you end up having these nightmares where something like this happens. You've been filing something and it's incorrect for 5 years. And it's like, how do I fix that? Meaning that I've been flowing through results that weren't allowed because they should have been corporate, because I blew the S election. And so those types of things you hope don't happen, but you practice long enough, you find out facts. Great question. I'll look at that and see if you have to affirmatively report that. Okay, so I think I'll pick these up. I'll start here on Wednesday with the operating issues, and we'll finish S Corporation, and then I'll probably do either a course wrap up, or we might do a little mini review where I send out topics and see if we can talk about something.
You need meds. I bought.
I'm not drop it. I was sick, dude.
You a little bag of.
Yeah, I don't think I got it.
Actually, I will.
I might have. I was sick.
I think I went through like all my chapters and I wrote down anything I thought could go on this sheet, and then the last second I just like, all my like my roommates kind of like that. It's like a long document. I'm like, if you're gonna make this fit, it's
S Corporation would have to be the acquirer.
It's like twice as much.
S Corporation.
Yeah, but again, the small things are very different. His mom takes it like serious, but then his sister is basically like it's like a younger, because he has like an old soul, like what I'm saying. That's what his mom's perspective is. Yeah. But then when I saw it, I was like, they're kind of the same. Huh? I'm talking about Sebastian's sister, Sebastian. But she's going to her today, 6:45. I have to meet her now. Yes, prep session right now. Yeah, it's virtual, so we can just take it anywhere. We can find a room somewhere, sit down, take it together. Claude, we have the prep session now. MSTED prep session. Field trip. The field trip on Friday, we have a prep session right now from 1 to 1:30 or 45. Can you shut off?
Okay, I'm gonna send it to you.
Okay.
What's the prep session?
Like what do you want to do? Like when you go there, like what's the expectation? This, yeah. Because it's like a company visit. If you're going in, Washu's going for the first time to MSTED, so I know have to make an impression. So like,
Did you go to that one, the other one?
yeah, Bungie.
So what did you do at Bangalore?
Pretty much the same thing she's gonna say.
So it's the same.
Yeah, for me it's fine. But again, I have to be there because I'm the one organizing. But you have to attend because you didn't go. Yes, exactly. Yo, we have a prep session.
Grandpa or whoever's already long gone, so there's older generation of trust and all kinds of views of ownership. But they managed it appropriately, so it's less than 100%. Add it up, but it's to deal with all these intergenerational and marriages and divorces and all this chaos. army of lawyers and advisors. So I'm sure they were happy to do a transaction such as that. And these things do involve a lot of M&A stuff. But, you know, they got like one arm behind their back because they can't admit a foreign shareholder. Thank you. Yeah.
I came in late.
Yeah.
So
Absolutely.
thank you.
How are you?
How are you doing? Pretty good.
Are you gonna send out like a thing for us to write?
Yeah, I'll do that. I'll do that.
Thank you so
You
much.
bet.